Imagine opening your portfolio one morning and seeing a number so extreme that your first thought is, this has to be a glitch. Your heart skips, your brain freezes, and for a brief second, reality feels different. Now imagine that same number flashing live on one of the most trusted financial news networks in the world. That is exactly what happened when XRP appeared at 126 on CNBC. Not on a random website, not on social media, on live television, and the moment it happened, the entire crypto world stopped and stared. Welcome back to We Are Cosmic. If this is your first time here, this channel is where we break down crypto, finance, and digital assets from an expert, data-driven perspective without hype, without confusion, and without emotional noise. We focus on what institutions are doing, what the data is saying, and what retail investors often miss. If that sounds like your kind of content, make sure you're subscribed, because what we're about to unpack today goes much deeper than a simple price glitch. When CNBC's Crypto World broadcast showed XRP at 126.6, it didn't just look wrong, it felt wrong. At the time, XRP was trading calmly between 1.74 and 1.91. No massive green candle, no volume explosion, no global panic buying. Yet there it was, a triple-digit XRP price displayed on a platform that manages data feeds used by banks, hedge funds, and wealth managers worldwide. That single image spread across social media like wildfire and instantly split the community into two camps. Those who called it a harmless technical error, and those who felt they had just seen something they were not meant to see yet. This wasn't a small mistake. The difference between the real market price and the CNBC price represented a 6,500% anomaly. That kind of number matters, not because it was real, but because of what it does psychologically. When people repeatedly see a price, even by accident, it starts to feel less impossible. Triple-digit XRP suddenly becomes imaginable. And once something becomes imaginable, it becomes discussable. Once it becomes discussable, it starts shaping long-term expectations. Now here's where things get interesting. This glitch did not happen in a vacuum. We are in early 2026, a moment where Ripple has already moved past its legal battles, XRP spot ETFs are live, and more than $1.4 billion in institutional money has flowed into regulated XRP products. At the same time, daily trading volume has shifted away from retail platforms and toward professional exchanges and OTC desks, handling close to $5 billion per day. In other words, while retail investors are watching price, institutions are quietly building infrastructure. So the question is not just, was this a glitch? The real question is, why do these glitches keep happening to XRP, and why now? XRP has a long history of strange price anomalies on major platforms. We've seen $50 on Gemini. We've seen absurd six-figure numbers on CoinMarketCap. We've seen flash wicks into the stratosphere on Kraken. Bitcoin and Ethereum don't do this. Smaller coins don't do this. XRP does. Over and over again. And that pattern deserves serious analysis, not memes or blind hype. In this video series, we are not here to sell you fantasies. We are here to separate technical errors from structural signals. We are going to break down what caused the $126 CNBC price, how a simple data feed crossover can create massive valuation ghosts, and why these errors tend to leap upward instead of collapsing to zero. More importantly, we're going to connect this moment to what's happening behind the scenes. ETF inflows, banking integrations, whale accumulation, and the construction of a multi-billion-dollar institutional price floor. So let me ask you this, and I want you to think carefully before answering. Do you believe repeated glitches are meaningless accidents? Or do you think they are stress tests revealing how fragile our pricing systems become when an asset starts integrating into global financial rails? Drop your thoughts in the comments. To understand what really happened on CNBC, we need to slow things down and remove emotion from the equation. Markets don't move on feelings, and neither do data systems. What looked like a shocking leak was not a prophecy and not a secret reveal. It was a data feed crossover, and once you understand how those systems work, the entire event becomes much clearer and far more interesting. CNBC does not set crypto prices. Like almost every major financial media outlet, it relies on aggregated back-end data feeds provided by third-party data vendors. These vendors pull live prices from multiple exchanges, normalize the data, and route it to tickers that appear on television screens, trading dashboards, and institutional terminals. When everything is mapped correctly, viewers see accurate prices. When something goes wrong in the routing, one asset can briefly inherit the price of another. that is exactly what happened here. During the live broadcast, the XRP ticker on CNBC was temporarily mapped to Solana's price feed. At the time, Solana was trading close to 120 SECs, while XRP was still sitting under $2. The system did not invent a number. It simply displayed the wrong one. This is important because it tells us the glitch wasn't random noise. It followed a real market value from another large cap asset. When analysts later overlaid the price movement from the broadcast with Solana's live chart, the match was nearly perfect. The jump, the flat behavior, even the micro movements aligned. That confirms this was a back-end mapping error, not market manipulation, not insider leakage, and not price discovery happening early. Technically speaking, the case is closed. But here's where most people stop thinking, and where they shouldn't. The real story isn't that a data feed failed. The real story is why XRP's ticker was even close enough in the system architecture to Solana's feed for this error to occur. These systems are grouped by liquidity class, institutional relevance, and trading volume. XRP is no longer treated like a speculative altcoin. It sits in the same data clusters as assets that handle heavy institutional flow. At the time of the glitch, XRP's daily trading activity across exchanges and OTC desks ranged between $4.4 and $4.9 billion. That level of volume pushes an asset into a different operational category. It requires faster routing, deeper liquidity modeling, and tighter integration with institutional-grade infrastructure. The more complex the system becomes, the more sensitive it is to small configuration errors. So, while the 126ers price itself was false, the environment that allowed the glitch to happen is very real. Another detail most people missed is timing. This glitch occurred while XRP liquidity was shifting away from retail-heavy exchanges toward professional venues. At the same time, wrapped XRP products were becoming active on other networks, including Solana. That increases cross-chain data dependencies. More bridges mean more data paths. More data paths mean more opportunities for routing mistakes. This is not unique to crypto, by the way. Similar cross-feed errors have happened in equities, commodities, and FX markets during periods of structural transition. They usually appear when an asset is being upgraded from one market role to another. XRP is going through exactly that process. Now let's address the obvious question. If this was just a technical error, why did the price jump upward instead of collapsing to zero or showing nonsense digits? Because systems don't search for random, they search for anchors. When a feed breaks, the system tries to resolve the error by snapping to the nearest valid price source within its permitted data group. In this case, that anchor happened to be Solana's valuation. This is why these glitches often leap into extreme highs rather than extreme lows. Lows require sell pressure, high anchors simply require a valid reference point. So no, the 126's price was not real. But yes, the glitch exposed something important. It showed us that XRP is no longer priced, routed, or handled like a fringe asset. It is embedded deep enough into institutional systems that when something breaks, it breaks loudly, visibly, and globally. And that brings us to the next layer of this investigation. Because this is far from the first time XRP has glitched into impossible numbers. Now that we understand the technical reason behind the $126 CNBC glitch, it's time to look at the bigger picture, because this was far from an isolated incident. XRP has a long, unusual history of price anomalies that set it apart from Bitcoin, Ethereum, and nearly every other major cryptocurrency. To understand why, we need to combine market mechanics, order book structure, and institutional activity. Let's start with the obvious examples. In August 2023, Gemini users were shocked when XRP flashed to $50 shortly after relisting. In 2021, CoinMarketCap and Coinbase displayed valuations in the hundreds of millions per coin, obviously not reflective of actual trading. Even in late 2025, Kraken experienced a sudden flash wick where XRP temporarily spiked to $91.60. These aren't minor errors, they are systematic anomalies that occur repeatedly, which suggests there's a structural reason behind them. So why does XRP experience these glitches more than Bitcoin or Ethereum? The answer lies in liquidity distribution and order book gaps. Large cap cryptocurrencies with active retail trading typically have deep order books, meaning there's always a chain of buy and sell orders at every price level. When something fails, the system has smaller gaps to correct itself. XRP, however, has unique trading behavior. Large institutions handle the majority of its volume through professional exchanges and OTC desks, while retail trading remains scattered. This creates vacuum pockets. price levels where no significant sell orders exist. When a data feed or exchange system encounters these vacuum pockets, it doesn't settle at an arbitrary price. Instead, it anchors to the nearest available valid price, often far above the current market. That's why glitches often jump into triple digits instead of dropping to zero. These are the ghost valuations that traders see, temporary, extreme numbers that hint at the latent potential of XRP's institutional integration. There's also a psychological factor. Repeated exposure to these anomalies changes perception. Each time the screen shows $50, $91, or $126, it normalizes the idea of high-value XRP in the minds of investors. Even if the number is false, it starts to feel possible. This isn't hype, it's behavioral finance at work. Human brains anchor on visible numbers, even if they know rationally they're a glitch. Another reason XRP is prone to flash valuations is its integration into multiple networks and financial rails. Wrapped XRP exists on other blockchains like Solana. ETF products are live. Banks and treasury platforms are actively incorporating XRP into their workflows. Each new layer adds complexity to the data feeds. More complexity shows more potential for glitches because even a minor routing error can produce a massive jump in the ticker. Finally, consider this. These anomalies happen during structural growth periods, not stagnation. The $126 CNBC glitch occurred right as Ripple's institutional flows were growing, XRP ETFs were launching, and liquidity was moving away from retail-focused exchanges. Each glitch is a signal, not of instant price, but of structural transition. The market is testing its infrastructure, stress testing the systems that will eventually support trillions in value. Now that we've examined the technical glitches and XRP's history of anomalies, it's time to shift focus from what retail sees to what smart money is actually doing. Because while retail investors get distracted by flashes on screens, institutions are quietly building a multi-billion-dollar foundation under XRP, brick by brick. In early 2026, XRP is no longer just a speculative coin. Spot ETFs have launched, regulated funds are flowing in, and professional investors are accumulating strategically. For example, over $1.4 billion institutional inflows were recorded in the first weeks of 2026 alone. This isn't hype, it's real capital moving through regulated channels from asset managers like Franklin Templeton and Grayscale. These institutions are not chasing short-term gains, they are positioning for long-term adoption and utility. At the same time, we are seeing a significant migration of whale wallets. On-chain data reveals that in just the first 3 weeks of January 2026, 42 new addresses holding at least 1 million XRP each appeared. These aren't casual traders. They are strategic accumulators positioning ahead of Ripple's technical roadmap and upcoming adoption milestones. The increase in top-tier wallets is a clear signal that professional players view the current price floor around 174, 191 as a generational entry point. This shift has profound implications for price behavior. While retail investors may panic during sideways markets, institutional accumulation creates a structural floor. Large buy orders from professional accounts reduce the probability of sharp downside moves. In other words, the market is no longer purely sentiment-driven. It's increasingly anchored in actual demand from sophisticated players. Another critical point is the separation between retail sentiment and institutional conviction. While retail attention is often drawn to flashy headlines and technical glitches, the real action occurs behind the scenes on regulated platforms. XRP's daily volume on professional exchanges and OTC desks now reaches nearly $4.9 billion, dwarfing typical retail activity. This means that even if the price appears stagnant on public charts, significant accumulation is occurring quietly, reinforcing long-term stability and growth potential. We can also see the effect of these flows on market psychology. Repeated exposure to institutional activity creates what we call a confidence anchor. When whales and ETFs consistently buy at current levels, it tells other investors, even those who aren't paying close attention, that XRP is a serious, institutionally recognized asset. It's no longer a fringe token. It is becoming a foundation for the global financial system. Importantly, these institutional flows are not speculative bubbles. They are anchored in utility. Banks, corporate treasuries, and regulated funds are integrating XRP into real-world financial systems. Ripple's partnerships, like the Hogan Core banking integration, bring hundreds of millions of bank accounts onto the ledger. This means that each XRP held by institutions has a clear functional purpose, not just a price target. Finally, the accumulation phase highlights a key principle of professional investing: patience over hype. Institutions do not chase $126 flashes or media glitches. They focus on structural adoption, liquidity management, and compliance with global regulatory frameworks. By doing so, they are effectively engineering a price floor that retail sentiment alone cannot achieve. So far, we've covered technical glitches, ghost prices, and institutional accumulation. But now we need to look at the bigger picture. How XRP is becoming more than just a coin. It's becoming infrastructure. While retail often focuses on price action, the real revolution is happening behind the scenes as Ripple integrates XRP into traditional finance and corporate operations worldwide. One of the biggest developments is the Hogan Core banking integration. This is not just a small pilot. Hogan is a core platform that supports over 300 million bank accounts globally and manages $5 trillion in deposits. By embedding XRP ledger rails directly into this existing infrastructure, Ripple allows banks to offer digital asset services without overhauling their systems. This is huge because it eliminates the biggest barrier to mainstream adoption: system compatibility. Banks don't need to rebuild their software. They can settle payments, manage liquidity, and even tokenize assets using XRP. This kind of integration fundamentally changes the role of XRP. It is no longer a speculative token traded for short-term gains. It is now a bridge asset connecting traditional banking systems with the fast, programmable efficiency of blockchain. Money can move almost as easily as data. Payments that once took days or incurred high fees can now settle in seconds, and the same XRP ledger can support billions in daily institutional volume. Ripple is also forming strategic partnerships with corporations to embed XRP into global treasury and settlement operations. Take the example of RLUSD, Ripple's stablecoin, which is now being used for credit card settlements via MasterCard and Gemini. This creates a consumer-facing corridor where XRP isn't just institutional, it starts touching everyday finance. Countries like Singapore and Saudi Arabia are adopting regulated frameworks, further expanding XRP's real-world utility. These aren't abstract experiments, they are practical applications that create actual demand for XRP as a bridge currency in multi-trillion-dollar corporate treasury markets. Then there's the corporate treasury adoption. Ripple's acquisition of G Treasury is integrating XRP into the payment rails of over 1,000 corporate treasuries, including major companies like Goodyear and American Airlines. These corporations aren't speculating on price. They are using XRP to manage liquidity efficiently. When Fortune 500 companies start holding XRP on their balance sheets, it signals that the asset is becoming a production-grade infrastructure layer, not a short-term bet. The combination of banking integrations and corporate adoption also explains why XRP's technical glitches create such fascination. Each anomaly is a glimpse into a system that is being stress-tested for institutional scale activity. While retail investors saw $126 on CNBC, banks were quietly moving millions of dollars in regulated channels. The market floor was being built silently, and the rails for a global financial network were being activated. Another important factor is redundancy and risk management. Institutions use multiple exchanges and regulated corridors to ensure liquidity is always accessible. This is why XRP's system is being designed with multiple paths to access liquidity globally. Even if one region faces friction, ETFs and corporate flows continue elsewhere. These structural protections make XRP more resilient than retail narratives suggest. Now that we've walked through technical glitches, ghost valuations, institutional accumulation, and Ripple's corporate integrations, it's time to tie everything together. By examining all these pieces, we can understand not just why the $126 CNBC glitch happened, but what it signals about XRP's long-term trajectory. The key takeaway is this: the glitch was temporary, but the underlying trends are structural and real. XRP is no longer just a token that traders speculate on. It has become a bridge asset, deeply integrated into institutional finance, corporate treasury systems, and regulated investment products. The daily trading volumes of nearly $5 billion, the rise of millionaire whale wallets, and $1.4 billion in ETF inflows are concrete indicators that XRP's foundation is being built beneath the retail noise. Let's break down what this means for the future. First, price behavior will increasingly reflect institutional demand rather than retail sentiment. While the retail market can still cause short-term volatility, the structural support from ETFs, OTC desks, and corporate adoption provides a floor that prevents extreme downside moves. This is why, even during sideways markets, XRP remains stable despite occasional flashes like the $126 glitch. Second, XRP's adoption in traditional banking infrastructure ensures that utility and real-world demand will continue to grow. The Hogan Core banking integration, G-Treasury adoption, and partnerships for stablecoin settlements with MasterCard and Gemini mean that XRP is being used to move money at scale, not just as a speculative token. These integrations create a feedback loop. As usage grows, more XRP is required to facilitate transactions, which further strengthens the market foundation. Third, the history of flash valuations and anomalies serves as a unique psychological phenomenon. Every time a ghost price appears, it reinforces the idea that XRP can operate at much higher levels than its current market price. While these numbers are not real, they prepare investors to think in triple-digit terms, aligning expectations with the eventual institutional scale the network can support. Fourth, corporate and institutional adoption is accelerating. By the end of 2026, estimates suggest corporate balance sheets will hold more than $1 trillion in digital assets, with about half of Fortune 500 companies formalizing digital asset strategies. Ripple's infrastructure allows these companies to onboard digital assets without overhauling their current systems, meaning adoption is scalable and sustainable. Finally, what does this mean for investors? The biggest lesson is focus on structural trends, not hype. Price glitches, flashy headlines, or social media speculation are distractions. True insight comes from understanding who is accumulating, how XRP is being integrated into financial systems, and where liquidity is moving. Investors who focus on these fundamentals are better positioned to navigate volatility and recognize opportunities early. In conclusion, the $126 glitch was an anomaly, but it highlighted a bigger reality. XRP is evolving into a global financial bridge supported by institutional flows, banking integrations, and corporate adoption. The technical errors were temporary, but the infrastructure being built now will define XRP's trajectory for years to come. This is why, for long-term investors, understanding the real story behind the numbers is far more important than chasing screen prices. So here's my final thought for you. Watch the infrastructure, follow the institutional flows, and pay attention to adoption signals. The glitches are entertaining, but the rails are what matter. XRP is moving quietly, steadily, and structurally toward its role as a foundational digital asset for the global financial system.